Imagine waking up to find your bank account has grown overnight. Not from your 9-to-5 job, but from smart investments you made months or even years ago. Sounds too good to be true. Well, it's not. This is the power of dividend investing, and today we're diving deep into how you can make it work for you. Welcome to the Savvy Finance Corner YouTube channel. Wealth begins with knowledge. Passive income has become the holy grail of financial independence, and for good reason. Unlike the daily grind of a regular job, passive income streams keep flowing with minimal effort on your part. Among the various strategies to achieve this, dividend investing stands out as one of the most accessible and proven methods. It's not about flipping houses or starting a side hustle. It's about owning a piece of successful companies and reaping the rewards of their profits. But what exactly is dividend investing? At its core, it's the practice of buying shares in companies that regularly share their profits with shareholders through dividend payments. These companies, often household names like Coca-Cola, Johnson & Johnson, and Procter & Gamble, have been filling investors' pockets for decades. Imagine getting a slice of these corporate giants' profits, typically every quarter, without having to clock in or answer to a boss. You can either pocket this cash or reinvest it to buy more shares, potentially snowballing your wealth over time. Now, you might be wondering, why should I choose dividend investing over other strategies? Well, the advantages are compelling. First off, it provides a steady stream of income, a godsend for retirees or anyone looking to boost their monthly earnings. But it's not just about the here and now. By reinvesting those dividends, you're tapping into the magic of compound growth, where your returns start generating their own returns. It's like planting a money tree that keeps growing bigger and bearing more fruit. Plus, companies that pay dividends are often the stalwarts of the business world, offering a blend of growth, potential, and stability that can weather market storms. To really succeed in dividend investing, you need to get familiar with a few key metrics. Think of these as your financial compass. Dividend yield is like the interest rate on your savings account. It tells you how much you're getting back relative to what you VA put in. A higher yield might look tempting, but be cautious. If it seems too good to be true, it might be. The dividend payout ratio shows you how much of a company's earnings are being handed out as dividends. It's a balancing act. You want a generous company, but not one that's giving away the farm and leaving nothing for growth. Dividend growth rate is all about momentum. Companies that consistently increase their dividends are like star athletes. They re-showing strength and commitment to their shareholders. And then there are the dividend aristocrats, the cream of the crop. These are companies that have raised their dividends for at least 25 years straight. They're the blue chip stocks of the dividend world. Building your dividend portfolio is like creating a well-balanced meal. You need variety and quality ingredients. Spread your investments across different sectors like consumer goods, healthcare, utilities, and financials. This diversification is your safety net, ensuring that if one area takes a hit, your entire portfolio doesn't crumble. You'll also need to decide whether to pick individual stocks or go for dividend-focused ETFs, which offer instant diversification. Set realistic goals. Maybe you're aiming for $500 a month in dividend income. Having a clear target helps you stay focused and motivated. But let's be real, no investment strategy is without risks. Even dividend investing has its pitfalls. Companies can and do cut dividends when times get tough, which can leave a hole in your income stream. Some high-yield stocks are like sirens, luring investors with attractive payouts that mask underlying problems. And yes, market downturns can be nerve-wracking, even if your dividend checks keep coming. Being aware of these risks is half the battle in avoiding costly mistakes. So, how do you put all this knowledge into action? Start with thorough research. Look for companies with strong financials and a history of consistent dividends. Use stock screening tools to filter based on yield, payout ratio, and growth rate. Once you've identified potential investments, focus on building a balanced portfolio. Don't put all your eggs in one basket or one stock. And remember, reinvesting those dividends is key to harnessing the power of compound growth over time. In conclusion, dividend investing is more than just a way to generate passive income. It's a powerful strategy for building long-term wealth. It combines the stability of established companies with the exponential growth potential of reinvested earnings. By understanding the key metrics, diversifying wisely, and managing risks, you can create a portfolio that not only provides a steady income stream, but also grows year after year. Even if you're starting small, consistency and patience can lead to significant results over time. Remember, in the world of dividend investing, it's not about getting rich quick. It's about building a sustainable financial future, one dividend at a time.